Hi, I'm Connie Loizas.
And this is Alex Gove.
And this is Strictly VC Download. Good evening, good morning, and good day, depending on what time you are clicking on this baby. How are you, everyone? We hope well. We also hope you will enjoy our interview with this week's featured guest, John Korngold, the global head of Blackstone Growth, or BXG as they call it. Blackstone Growth is the investing giant's growth equity arm, meaning it's mostly taking minority bets, very big ones, on mature companies that can take advantage of the many services Blackstone has to offer them. The outfit just closed its first fund officially today with $4.5 billion, but it already has a huge win on the books. Korngold is a career investor who joined Blackstone in 2019 after spending around 18 years with General Atlantic. And within months, he'd sewn up a deal to take a majority stake in the parent company of the dating app Bumble. At the time, Blackstone paid $2 billion for the company at a $3 billion valuation. Fast forward, and Bumble is now a publicly traded company as of last month, and not only has Blackstone made back that $2 billion investment in a sale of some of its shares at the IPO, but its remaining stake in the company is valued right now at $7 billion. Not bad for 17 months' work. We'll get to that interview in just a few minutes, but first, a quick dive into some of the week's news. Yesterday, as readers of the newsletter may have noticed, I covered a new fund from the team that manages Mr. Beast, a hugely popular YouTube personality who's like a modern-day game show host, giving away money for the most part, but also homes and other things. The fund seems both a sign of the times and an indicator of what's around the corner. Like the Chainsmokers, the famous DJ duo who we interviewed for this podcast last year, Mr. Beast, who is really 22-year-old Jimmy Donaldson, is every bit a celebrity and more to a generation of viewers that includes our interns. They love him. These creators have their attention, and through that attention, they are amassing serious financial means. And a lot of them are beginning to think about next steps. How seriously this new fund will be taken by VCs isn't clear, but I'm guessing pretty seriously. They obviously have a much better grasp on cultural shifts than do a lot of people who don't come from that world. And in VC, seeing the future is what it's all about.
The pandemic has certainly benefited the fortunes of Google, Facebook, and Amazon. A fascinating article in today's Wall Street Journal reveals that this triopoly now accounts for more than 50% of all advertising dollars in the U.S. According to numbers from Group M, an advertising agency holding company, the combined market share of Google, Facebook, and Amazon relative to other advertising companies grew almost 18% from 2019 to 2020. Amazon saw the greatest percentage gain, increasing its share by over 51% to 6.3% of total U.S. ad spend. One big driver for this shift is the amount of personal data these companies are collecting based on the countless hours we are all spending in front of our screens these days. These companies that are data science driven get stronger and faster with a tailwind of usage, and COVID was a hurricane, said Tim Armstrong, a former Google executive and AOL CEO who now leads Flowcode, a direct-to-consumer platform company. Advertisers like Steelcase, which makes high-end desk chairs, are hooked. During the holiday season, Steelcase stopped advertising in business publications and redirected all of its advertising dollars online. It was a smart move. The company estimates that it generated $30 in sales for every dollar it spent on Amazon ads. Similarly, Suzy Batiz, founder of Poo Pourri, a company that sells a line of bathroom scents, redirected her advertising budget away from stores like Bed Bath & Beyond and towards platforms like Facebook. Sales on Poo Pourri's website surged 300% in the second quarter versus a year earlier, and more than doubled for the year. "This is our future," she told the Journal. "I don't think we will ever go back."
Last but not least, I thought I'd share a preview of a story I'm writing at the moment about Civo, a 6-month-old startup that just passed through Y Combinator's famous accelerator program, and that piqued our interest for a number of reasons. First and foremost, what it's selling could be of interest to a wide number of people, and that is debt as a service. It's basically lining up debt deals with traditional providers, then parceling out that debt to companies that use its API so that they can then lend the money to their own users. It sounds like it's just making interest off many smaller loans that it's providing from capital it has itself borrowed. It's true, but there's ostensibly a risk analysis component here that could make it interesting to startups. A lot of these young neobanks, for example, and other outfits don't necessarily have massive risk management groups in place or don't want to build them out themselves. And Sivo's promise, at least, is that it can also handle this piece of the puzzle. It figures out who its customers should lend to, then it gives them the debt to do it. Its founder, Kate Hiscox, who has founded a number of companies over the years, beginning with her first year out of high school, and who has taken one of those companies public in Canada, calls it a kind of Stripe for debt. One question is how a company like this does once interest rates rise, and the debt that it's borrowing is no longer so cheap. But a bigger one is how Stripe itself might feel about Sivo. Stripe was also once a Y Combinator company. In fact, it's the most highly valued privately held company to come out of the accelerator. And it also lends debt to its customers. Hiscox says the two don't compete, but I'm not sure that's 100% accurate. And either way, you could kind of imagine that however long Sivo exists, or exists as a standalone company, it's going to be tied closely to whether Stripe decides that it's friend or foe.
Up next, our interview with John Korngold of Blackstone Growth. But first, a word from our sponsor. Connie, you know you should be using a VPN. What's holding you back?
I don't know. They're just so slow.
Yep, but a recent test by AV-Test found that NordVPN is up to 3x faster than the competition. I've been using NordVPN for the last month. It's true. And I haven't noticed any dip in performance.
What about security?
NordVPN doesn't log your data, and it offers double data encryption for increased anonymity.
Wow. I know VPNs are great when you're on your computer in a cafe or in an airport, but we're not going anywhere these days.
That's true, but say you're researching a story. No matter where you go, you can remain anonymous. Go to nordvpn.com/strictlyvc or use code strictlyvc to get a 2-year plan plus 1 additional month with a huge discount. If for whatever reason you're not satisfied, there's a 30-day money-back guarantee.
You're so formal. How about if I just use your subscription?
That works too. One NordVPN account will cover 6 devices at once.
Sold.
For more information about NordVPN, please visit nordvpn.com/strictlyvc today.
John, when we spoke last, you were just getting this growth equity unit and fund off the ground. So maybe just catch us up a little bit. You were actively hiring. How many people are actively engaged in investing this new fund that you've raised?
Sure. So we've got about 30 people full-time dedicated to Blackstone Growth, in addition to the obviously hundreds, if not thousands of people more generally available to us within the Blackstone family. We've got people now in San Francisco, New York, and in London, full-time dedicated to BXG.
And so you are investing then primarily in the US and Europe.
It's a global fund,
Okay.
and it really does have global mandate. I'd say the majority of our activity is in North America and EMEA more generally.
You are just closing on this massive amount, $4.5 billion. How much of that has been invested already? When we talked, you were doing some deals off of Blackstone's balance sheet.
Yeah, in the beginning, we were using other pools of capital before this pool of capital was available to us. And now that we've got a handful of investments, in fact, a couple more to be announced this week. The team has been very, very active, and we've invested a pretty significant portion of our capital already. And it's probably north of 25% at this stage, although we officially technically close today or tomorrow on our final dollar. But fortunately, the fund was well oversubscribed above our original limit.
And then I guess half of that fund will be saved for follow-on fundings. I don't really know how a fund of this size works.
Yeah. So we're always, anytime we invest, we always expect and hope that we will continue to support our companies throughout. So unfortunately, we'll never have the problem typically of running out of money, but we do reserve a significant portion of it to fund the ongoing growth of the companies. The good news is many of our companies are already profitable. And so it's not as if you have to set aside a massive amount in reserve. If you recall, when we spoke last time, one of the things that we tried to do that's a bit different within BXG relative to many out there is we're looking for companies that are at the upper end of the growth equity spectrum. Bumble is a great example of that. Bumble's got $150 million of EBITDA and grows quite significantly year on year. So firms like Bumble are looking for us as an extension of their bandwidth to really take advantage of transformational opportunities that on their own, perhaps they wouldn't otherwise be able to consider. As a result of that, fortunately, we have the luxury of not needing to reserve as much because we think our companies are going to run out of capital. That's never really the problem.
Well, let's talk a little bit about Bumble because it is a huge outcome for you. It's just staged this hugely successful IPO. So, in the winter of 2019, from what I'd read, Blackstone invested $2 billion to take control of its parent company, Magic Lab, at a $3 billion valuation. There are other companies with similar metrics that you're looking for. Why did you think Magic Lab specifically was a good idea, and how did that deal come together?
Well, we thought it was a good idea because dating is not a fad. We learned that people will date in bull markets, they date in recessions, they date offline, and we've learned in hindsight they date in quarantine. People just crave companionship. And even before the quarantine, 40% of all new relationships that started began online. So it's become much, much more mainstream. And on the back of mobile phone penetration, we think that this is inevitable, will continue to increase. And it's not a US phenomenon. We see this globally. So we really liked the huge market opportunity. I have a simple rule in our team, which is if we have to size the market, it's too small. Because if it's not too small for us, it's going to be too small for the future, whether it's the public markets or others. And so we're really going after massive global TAMs, and dating certainly felt like that. The second thing we really liked was the opportunity to back Whitney Wolfe Herd. She is an exceptional entrepreneur, and she's been an exceptional partner and has really, I think, embraced the full set of resources that Blackstone was in a position to help give. And it's really been just a phenomenal partnership in showing how Blackstone can leverage its industrial grade scaled resources and help this company take advantage of just a massive global opportunity, but do it in a way that minimizes the operational strains that are sometimes associated with hypergrowth. That's really at a core what we really were attracted to, the opportunity to back a fabulous entrepreneur with a big market, with a very positive cash flow profile as well. I mean, all too often in consumer technology, you and I joked around about this in our first interview. We're not in the business of backing companies that sell $1 for 80 cents and hope that one day you grow your way into it. These are businesses that have proven unit economics. And that really was attractive to us as well, because we're looking for businesses that are like defensive growth. They'll thrive in good bull markets as well as in dislocated markets. And Bumble, just given its performance through both parts of that cycle, has demonstrated that durability.
I don't know if Bumble and Magic Lab had other options when you came knocking, but assuming that it did, can you elaborate a little bit more on what you did for that company? I know that when we talked, you walked me through the fact that you've got these data scientists and these portfolio companies, and there's just a lot of cross-platform muscle that you bring to a deal. But specifically in this case, how did you help fortify this company?
Well, the first was by cementing Whitney's leadership for the overall business. Historically, there were two parts of the business. It was Badoo and Bumble, and they were largely run separately. Whitney is the CEO, the single CEO of both companies together. As part of that, we were able to really establish the mission firmly of Whitney, where you put the female at the center of navigating both her professional life and her dating life together. So it was very much on point with the messaging of what we at Blackstone took very, very seriously. It's entirely consistent with our mandate, but it's also a way to actualize Whitney's vision of finding a place that is a safe haven for females to take much more control of their dating lives in an industry that was created by men for men. Whitney, just given her previous experience coming from Tinder, saw this as an opportunity to have that blank sheet of paper. The second thing that we did was we helped really augment the management team. In fact, we brought in 10 C-level executives alongside Whitney. Today, the majority of the Bumble team are female. We brought in 6 independent directors. 8 of the 11 board members are female. So once again, entirely consistent with our message. So starting with human capital, we consolidated the product development teams between Badoo and Bumble. We consolidated the marketing teams. We meaningfully upgraded the technology infrastructure. We put in place a lot more around reporting and repeatability to make sure that the company was going to be a great public entity. We consolidated their real estate footprints. They had multiple disparate units in London and Texas and elsewhere, and centralized that so we can ensure that the culture remained much more consistent. We got the company ready to be public in terms of Starbucks compliance, including prepping the company of what to expect as a public business, because we have a huge public side of Blackstone as well. And that's a fabulous synergy that helps complement our growth equity side of the business. We also have our data science, like you said. In fact, one of our data scientists was effectively seconded down to Bumble for the better part of a year to really help think through how to best monetize the exhaust and the value proposition of the core experience and really help deliver a superior product experience for its customers. And that has really proven to be instrumental. We also massively invested in product, one of which is video chat. Before the quarantine, and unbeknownst to us, obviously, at the time, that how important video is going to be, we introduced video dating before any other platform that was out there. And that proved to really be a phenomenal boon for our growth across quarantine, where video usage was up 80% on the Bumble platform.
Was this investment a part of the fund? Do your current investors in the fund benefit from the Bumble success?
Yes, they do.
It was quite a win for you guys. Given that the stock traded up nearly 77% on its IPO, do you think that it might have been better to have done a direct listing?
No, I don't think so. I mean, you look back in history, I think there's been a total of 5 direct listings. And so there's a role for direct listings. There's a role for traditional IPOs. We didn't mind that this thing was going to trade up. At the end of the day, we're trying to have a long-term view on this. We don't view the IPO as our source of liquidity. For us, IPOs represent strategic milestones in a company's development. And we have to be in the business of making sure that when we take our companies public, that the public market knows that we're not selling a wrung towel to them. There's real embedded upside. We have a very, very long-term view on these things. To us, it's a little bit noise when things trade up or not. And we're trying to do right by the ultimate shareholders longer term.
This deal was a little bit atypical in that it was a majority investment. Of course, it didn't involve Blackstone, the larger company. But is that going to be something that you'll be doing periodically with a growth equity fund, or this truly was anomalous?
Yeah, I'd say the vast majority of things we tend to do are going to be minority in nature, because many of the companies that we invest in, they're looking for a partner rather than an owner. And so if you're an entrepreneur and you have a business that grows 50 or 60% and you're profitable and you want to sell us majority, oftentimes, there's something that we don't know. So more often than not, I find growth equity, not just BXG, but growth equity lends itself to significant minority ownership positions. It just so happened to be in this particular case, given some of the legacy shareholder dynamics. We originally started looking at a 20% stake in Bumble, and we concluded that it actually solved multiple stakeholders' objectives more efficiently if we actually just bought the entirety of the business alongside Whitney and allowed us to streamline that. So we certainly will consider majority opportunities as well as they present themselves. Certainly carve-outs of larger public companies, we might consider that as well. But as a general matter, we're significant minority partners where we try to behave as invited guests alongside the entrepreneurs.
Right. I think you said at least initially 10 to 20 to 30%.
Yeah, enough that we have a relevant voice. Our goal is to not be one of 15 VCs around the table, which again, in a bull market, your influence is largely diluted because everything goes up. But I think across cycles, we think by being a true partner to management and being one of the few, if only, voices alongside that team really allows us to be more impactful over time. We just want to make sure we own enough that management views us as a real partner and that we're not overly prescriptive, whether it has to be 10 or 20 or 30%.
You said in your press release that BXG believes that its concentrated approach to portfolio construction, which focuses on a far more curated number of companies than what is typical of growth equity firms, will allow it to deliver more significant operational value to the individual companies in which it invests. Does that mean that you will invest a larger amount of money in portfolio companies than, say, a TPG Growth or a Summit, or just a fewer number of companies? And what is your pace for investing per year?
Alex, it's a little bit of both. In general, we tend to spend our time at the upper end of growth equity, $150 million and above. I'd say our average investment might be $200 to $400 million. But certainly, as you saw in Bumble and ISN, which is another one of our investments, where we invested $550 million in that one, we're capable of going much, much larger. And for us, it's a reason for a couple of things. One, a lot of the companies we're investing in, these regional champions that have real global aspirations. And so the scale of capital and the scale of operational intensity that's required to help them on that journey does push us into some of the companies that are a little bit more inherently mature, as opposed to going through their embryonic stages of development in the early VC days. The second is from a risk perspective, the $25 to $150 million range. It's a perfectly fine area. It probably constitutes 90% plus of the growth equity market. But what's happened there has been such a pollution of capital. You have everyone there, everyone. You've got family offices and sovereign wealth funds and individuals and crossover funds and big growth funds moving downstream and hedge funds and mutual funds. And it's okay to be there, but it's not okay to be there if you don't have the engines to move to smoother air and where we can use our scale to create an operational advantage, which in turn creates a sourcing advantage. Because one of the things that we have noticed is that it used to be a Series B investment was like a $20 million round. Now you've got like Series B investments are $100 million rounds because there's so much capital. So the businesses themselves are not inherently more mature, but you're just writing bigger checks. So you're taking the toxic combination of binary risk of VC at growth equity scale. And so we're trying to stay away from that side of the market where possible. Also, because I don't think the world needs another growth equity firm playing in the $25 to $100 million check size. The other, as it relates, Alex, to your question about a more limited number of companies, in a bull market, if you look at much of the growth equity ecosystem, the vast majority of growth equity firms began their institutional lives as venture capital firms. And there's no judgment in that at all. It is what it is. And that made sense because there was a time when growth equity was technology investing. So naturally, the way you assemble a portfolio in technology, especially technologies that have more binary outcomes of zeros and ones, is you have massive diversification. The premium in that world is on finding the winning company, finding the winning trend, and that makes up for a bunch of operating sins along the way. Therefore, it's not uncommon when you see many companies have hundreds of portfolio companies, but very little in the way of operational support for these businesses. So there are many out there that are called growth equity, but really it's VC at scale. And you fast forward, I think, to this day and age where the world is flooded with capital, where it's not enough to just find the winner anymore. You have to be in a position to make the winner. And so the thesis that we started BXG with was that those growth equity firms who can align themselves to the largest base of strategic and operational resources will be in a position to fundamentally change the outcomes and hopefully be a kingmaker in the industries in which they're focused on. And so for us, we said, how do we leverage the approximately $620 billion of capital that Blackstone has and the massive level of operational resources, 100 plus operating executives, dozens of data scientists, nearly 1 billion square feet of e-commerce logistics warehouses. We buy centrally on behalf of 450,000 people. We have $165 billion of revenue that we can cross-sell into, or at least make introductions to. We're almost always one of the largest fee payers onto Wall Street. And so we invest in financial technology companies. We have C-level relationships with all the key financial institutions. But all those resources are helpful only if you can apply them to fewer companies. When you sit on 15 boards, you just don't have enough time in your day to actually add value. So for us, we generally are trying to invest in 15 to 20 companies or so over the life cycle of our fund. Different than many growth firms, which will invest that in 4 months. We're trying to do that over a concentrated position. And in doing so, none of us will ever typically sit on more than 2 or 3 boards over an investment horizon. And that does really allow us to function as a strategic in the skin of a growth equity firm.
John, you obviously just made a very strong case for why people should consider your group. At the same time, I wonder if instead of competing now with other growth equity outfits, private equity firms, you have SPACs to contend with. I don't know if this trend is going to last, but if it does, I could have seen a Bumble, for example, being approached by a SPAC sponsor and taken public that way. I just wonder how you are thinking about this new mechanism.
Yeah, sure. I mean, there's no company that is out there in technology that hasn't somehow been approached by a SPAC. And I'm sure if Bumble were private, it would also be approached by a SPAC. I don't really view SPACs as competitors, but I think importantly, I mean, it's easy to crap on SPACs. There is a role for SPACs. It's no longer the dirty 4-letter word, perhaps it was years ago. You do have many more credible sponsors that are behind these SPACs. And so there is a role for them. I do think there are going to be many, many more SPACs than good deals to actually invest, especially when the perverse incentive is you got 24 months to invest the money, and it's better to do a bad deal than no deal at all if you're the SPAC sponsor. So there is a fundamental misalignment in the current model of SPACs that I think has led to an arbitrage that we haven't seen in many, many, many years. And it's given people who wouldn't normally have access to institutional grade capital to almost have like a weaponized approach to institutional grade capital. So there's a role for them. But I think in order for SPACs to really persist over a longer horizon, they're going to have to deliver outsized returns if they're going to exist. Just like direct listings. I remember years ago, people said, oh, the IPO market's going to go away. And the practical reality is there's been 4 or 5 total direct listings in history. And so I don't see SPACs displacing IPOs. I certainly don't see them displacing growth equity because, again, if you're a SPAC and you have no operational resources, you can't do any of the things we just talked about.
John, can I ask you quickly about a newer portfolio company? I think it just announced its funding this week, Epidemic Sound, which is a 12-year-old Stockholm, Sweden-based marketplace that licenses its library of rights-cleared production music to broadcasters, airlines, hotels, and also generates royalties from that music on streaming services, which is a huge opportunity. This is a really interesting company. I'm just wondering how you found it and, again, what you can do for this company.
This one we really like for a bunch of reasons. The first is there is a marketplace scaled benefit to this. The company is the single largest provider of royalty-free rights for people to be able to what they call soundtrack the internet. right? So roughly 30,000 new videos get posted every hour on YouTube alone. Think about that, 30,000 every hour. And these videos are usually be accompanied by some music of some sort. And a lot of content creators, because there's an explosion of this video content across multiple social media channels, they don't want to have to deal with paying royalties, or even worse, putting music on that they didn't even realize was in violation of certain trademark restrictions. And so by accessing tens of thousands of tracks that in Epidemic's case get played 2 billion times a day, they know they're able to soundtrack their video posts without any risk whatsoever of violating that content. On the flip side, outside of celebrities like Beyonce and Justin Bieber and others who have record labels, there's a massive tail. 99% of artists globally are not getting picked up by a record label. And as a result of that, they have very little way to monetize their content. And they have virtually no ability to enforce the use of their content by someone else who's out there on the web using their songs. And so whereas an average artist might make $15,000 a year, when working with Epidemic Sound, they can make on average north of $50,000 per year. So you're really providing a phenomenal monetization engine for these artists who are in their home who don't have the luxury of being represented by record labels. We thought it was a massive global opportunity and the first derivative way of playing this explosion of video content, especially in a mobile native environment.
How do you help the company?
I think helping them expand internationally. And the company's based in Sweden. They obviously want to continue to make a larger presence, not only in EMEA, but now North America and in Asia. And we have 24 offices throughout the world with thousands of employees. So we can really help that company navigate their expansion in their respective markets. We're certainly going to help with hiring and building out their team and building out their board. Our data science resources are going to be incredibly valuable here. The company effectively at its core is a data business, right? It's a two-way marketplace where they've got this huge catalog and they use a lot of intelligence to serve up the right music to help content creators and posters to better navigate the tens of thousands of options they have. So our data scientists, we think, are going to be really instrumental in continuing to hone some of their algorithms to enhance the value proposition. So those are examples of ways at which I think will be quite helpful to this business.
And then, John, can I ask how competitive that deal was? And I guess just in terms of like valuations, what you are seeing. As you said, you invest above where many firms are investing. They're writing $25 to $100 million checks. You're writing $200 to $400 million checks. But still, I just wonder if you're having to pay up for the deals that you want.
Look, I think in growth equity, it's safe to say, I'd argue for all asset classes, but I can at least speak to growth equity. In this day and age, you're going to pay the full side of a fair price. And therefore, it really, I think, plays to our strength of being in a position to unlock operational synergies that are uniquely available to us because of the holistic Blackstone network that wouldn't otherwise be available to somebody else, as opposed to saying, I'll be the next marginal optimist and hope there's another greater fool who can pay more downstream. We're in a position to actually tangibly identify some of that value, so we can buy down our entry multiple in ways that perhaps others can't. That does go back to why we're micro investors instead of, I'd argue, more of a macro, almost index fund of growth equity that much of the ecosystem today bears some flavor of.
Got it. Well, John, really appreciate your time. And congratulations again, specifically on Bumble. That's pretty impressive.
Thanks so much. Big thanks to the management team. It's really their show, and we're just here for the ride, helping with whatever we can in the background.
Well, John, take care, and hopefully we'll talk again soon.
That sounds great. All the best. Thanks.
Thank you guys, and enjoy your weekend. If you liked what you heard, come back next week for more.